Let's switch gears for a second and talk about the secondary offerings, because there's activity in that marketplace this year.
Absolutely. I would say the IPO market is simmering. I would say the secondary offering market is boiling. Our firm alone here in New York, I've done over half a dozen in the last 8 weeks. We're talking companies that are looking to access the capital markets through takedowns off universal shelves. About 18 months ago to 2 years, the SEC loosened up the short form registration rule requirements such that now smaller reporting companies can access the capital markets even if they have a below $75 million public float. They're limited in what they can access, but they can still access it. Also, when you are a smaller reporting company, you do take down off a shelf and raise money in this market, you do have certain limitations you have to live by, even though you do have access to that short form registration.
So it sounds like there's an awful lot of creative deal making going on. I mean, not just with IPOs and secondary offerings, but also in M&A, right?
There is. You still have to navigate. You can raise money to do and operate in M&A world. You will get access. You still have certain rules you have to live by, which are a little bit different than the straight equity raises.
How is all of this affecting valuations?
What I'm finding is that people are trying to be more realistic.
At last.
Yeah, exactly. It's a refreshing change. I'm finding that advisors, accountants, not only financial advisors, but your accountants and your legal consultants are being more forthright with boards and board members and audit committees and saying to them, you need to take a longer look in the mirror. You can no longer just say, well, we'll get there, or yeah, that's about right. You can't have the mistakes of the past occur in the future. And so I think one of the mistakes in the past have been the overvalued valuations of companies.